Hey guys, so welcome to the fifth call on the mentorship on the 26th of October. It's currently Wednesday. I'm Ollie.
And I'm Jamie.
So today we're going over entry techniques, which I'm going to go over, and then Jamie's going to go over impulse blocks. Um, so yeah, without further ado, let's just get straight into it. Quite a simple, short and sweet call, but still valuable stuff to take in. So make sure you take some notes and yeah, let's get straight into it. Let me share the screen for you guys. I hope you're having a good trading week, by the way. Let's go on. Oh, admit. Let's go on USD, for example. Right. So, you guys probably know what all different entry techniques are. You have market execution, obviously, where you just instantly place for trade. So, say where price is currently. Let's just go over this for everyone. Might be beginners here, and then some of you are probably more advanced, so you know what I'm on about. So, say if I was to place a trade on Euro USD right now, that'd be instant execution. That'd be market execution. I'll place that in now, and I'd get in where the spread is. So price right now, I'd get in there. So either buy or sell there. But then let's get into buy stops, sell stops, buy limits, and sell limits. So what we'd do for a buy stop, we would here, for example, this were quite a lot of traders do. This is a strategy a lot use. So when they're looking for a target high or a low, they will have a limit, a buy stop, sorry, at the high or the lot for a sell stop. I'll go over after this for a buy stop though. They will have a buy stop at that high there. So price coming up, like you're probably thinking to yourself, why wouldn't you enter catch an entry down here? And then you're making profit up to the way up to there. But it's because this is safer. Like a lot of it's breakout traders, that's what they called. They do this. So they will wait for it to come up to here. It'll hit their buy stop, and then this can allow them to have. This allows you to have a wider stop, for example. So they enter there. I stop bother putting tape for it, and then they can have a stop below that low, for example. They could pull it out higher, but yeah, for example, like that. So it allows you to have a wider stop, and it's a safer entry because it's taken high. Um, if we go over a sell stop, it's exactly the same. I don't need to change chart actually. I could do it. This is at any time frame as well, guys. Just want to make sure it's clear for you guys. It's helpful as well with this when you're not on your phone, when you're away from your phone. So here, for example, this low, they would have had a sell stop there if they were going to trade this. And as you can see from the sell stop, it breaks that low and goes down from there. That was a bit of a bad example because it didn't move too much. But yeah, I think you guys get the gist of it. So you don't sell it from like here. You wait for it to come down. It's still coming down, and then as it's coming down, it hits you in. A sell limit and a buy limit are the opposite way, which we'll go over now. Um, yeah, is all that makes sense so far, guys? Yeah, just put in the chat quickly. Just so, yeah, if you get what all that is, or if you don't, just say yeah. No, okay, that's on. Yeah, so these always come in handy when you're sorry when you're away from your phone. There we go. That's getting all words out. Right. So a buy limit and sell limit. So a buy limit, what you do. So here, for example, it's coming up. We're bullish. It's come down. It's came up again, taking that high there, and it comes back down. You would have a limit for a buy limit somewhere around about here, say on the retracement. You'd catch an entry. So there on that red line, you enter. this allows you to have smaller stops. So let's draw it out again. Oh, so so, and then you would have a stop below that low there. So sell limits and buy limits, they are the riskier ones. They allow you to place smaller stops, as you can see, a lot tighter stops, but that is obviously riskier. Well, still same risk on the trade, but you know what I mean. There's less space. It gives you less space in the position. So here you see it came back down, and this would have played out. So this is the riskier one because it's tight stops, but you can catch some very nice R2Rs using this, using the sell limits and buy limits compared to the sell stops and buy stops. That'd be more suitable for a swing probably, um, where you have a wider stop. So yeah, you can see here. Let's get an example of a sell limit now. So I think does that make sense to you guys? So catch sell limits and buy limits on the retracements, not on the breakouts. So they're high or low. So yeah, well, that'll do. Right. So you can see it's going down, bearish, it's coming back up, and then on the retracement, you could catch a sell limit somewhere around here on that retracement. And then if we go down time frame, oh, where is it? All right. Yeah, so on the retracement here, you'd catch a, and you can put a stop above that high again, and then target that previous low there, for example. And then that would have given you a 1 to 2.6. Yeah, so that's the sell limit. The same as the buy limit, obviously, it's just the opposite way. Um, looking for a sell. So when this is dropping, it's dropping. On this, you're waiting for it to come back up and hit your limit. Having the limit above where price is. But when it's a sell stop, the limit will be the entry will be below where price is. So you're looking to come down, tag your entry. So for sell stop, you would have it there, for example, on that low there where our target would have been. Um, and yeah, that's pretty much it for the entry techniques, guys. Like I said, sell limits and buy limits are great for. Well, we'll go over in a few calls. I don't think we have been over it. Like an imbalance, and if there's an impulse plot, what Jamie will be going over, it could be great. If there's other confirmations, like when we teach you the model, it'll be great to if you can't be on your phone all the time and you see early on in the day there's a impulse block or imbalance and lines up with our model. You put a limit on for there and put a stop above, and then there you go. And then say you're at work, something busy, you just be able to place you in automatically and either hit you, take profit or stop loss, obviously. And yes, it can come in very handy the entry techniques. But if you can, I'd recommend doing market execution if you can be on your phone at the time. It's a lot less stress, I think. Instead of like not can't go on your phone and worrying about what's going on, missing your entries and stuff. But yeah, I think that's it, guys. Unless you have any questions, I'll hand it over to Jamie to go over impulse blocks.
All right, guys. So let's go over impulse blocks. So impulse blocks again, you can use them on any time frame, from the 1 minute to the monthly time frame. You can use them on any time frame you would like. So basically, what an impulse block is, so we have bullish and bearish impulse block. So it's dependent on where you think the price is going. Do you think it's going up or do you think it's going down? Now, obviously, you can see here on the Euro USD, we are in just a big bearish trend on the weekly time frame. So, here we'd be looking for bearish impulse blocks. Now, This up candle in here, this is a bearish impulse block. Now also I know it's a bullish candle, so it sounds weird giving it the term the bearish impulse block if it's a bullish candle. But the reason why it's called a bearish impulse block is because we're looking for it to, create a bearish move. We're looking for it to create down movement for the Euro USD. So I just draw this out here. So we have this bearish impulse block in here. You can see we come up, we tap into it here, and then you can see we drop down. So how we look at this impulse block is it's this last up candle before a big move down. Now, as you can see here, we had a big gap. So the price on the Euro USD here is really looking to push lower. And when it trades below this impulse block in here, when it does that, that is when the algorithm that we taught in the first call, it's changing its state of delivery. So when it's coming up in here on this week here, when it's going up, what it's doing is the algorithm is in a buy program. So it's delivering higher. When it starts to come down, when it trades below here, the open, it's not the low of the candle, it's the open of the candle. When it trades below that, that is when the algorithm has changed its state of delivery, and it's then going to be entered into a sell program where it's going to be looking to seek lower. Now, so you can see here we have the low of this candle here. You can see we come up to it and then we start to drop. What makes these impulse blocks valid is when you get a big movement down. So if it was just have small candles just coming down, 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 very small candles constantly, it wouldn't be one that I would prefer to take. Whereas when you get a big movement away from it, that's when I'd like to take it. And when you get gaps like this next to an impulse block, you can see that is where the confirmations start adding up. And again, you get it here. So this last up candle before a big movement down. So I draw this out. And you can also see again, we have this little gap in here from this week's low to this week's high. This is an imbalance that we're going to teach you very soon. And obviously got the impulse block here. So it all lines up really well. And then you can see the price just drops. Look at the reaction after it hits the impulse block. It drops nice and heavy. And then again, we have another one in here where we have this last up candle before a big down movement. You see how this candle after this impulse block, it's not a small candle like this one down here. It's big. It's aggressively moving away. So when it trades back up to it here, the algorithm will seek lower prices again. And as you can see, the reaction from it is very good. You can see it's very strong. And that's the sort of reaction you get. When it's a valid impulse block, these are the type of reactions you should get. And again, you have another one in here as well. So this up candle in here, and then it comes down. It also has a gap with it as well. It wicks up to it in here. Let me just delete that. It wicks up to it in here, and then it starts to drop. So you can see the reaction from these impulse blocks. They're really good. If I go into a 4 hour, you can see, another one in here. So we have this down candle in here. It's the last down candle. It takes out sell liquidity down here. And then look at the candle after it. Very big bullish candle. So this would be a valid impulse block. As you can see, it taps into it. And then look, it rallies. So you can use this again, like Ollie said, with the entry techniques. You could either have, a buy limit down here, and you can enter in on the retracement coming down to the impulse block. Or what you can do is you can wait for it to tap into the impulse block and wait for it to show a more of a reaction. And then you can have, a buy stop up here at these highs. And obviously, the buy stop will be the safer entry because you're getting more confirmation. Because if it's going to come down to the impulse block, right, let's say this impulse block was going to fail. If it was going to fail, it should just run straight through it and take this low. Whereas if it's coming into the impulse block, it taps it and then it gets back up to this high here, then it should rally. And as you can see, it did. And obviously not a lot, because obviously it's the time of day, like you're looking at late at night here. So obviously the time is very important as well in Forex, but we're going to go over the times in Forex And it's near one of the last calls. I think it's like the seventh call. We're gonna go over times. So you can see the reactions here. And I'll go on let me go on Euro GBP and I'll go on the 1 hour. Again, here you can see this up candle in here for this massive movement down. If I draw that out, you can see we tap it in here, then you can see we start to come down. We get a bit of a retracement up, but we don't take out this high in here. And then you can see we break down as well. And then again, we got one earlier. So you had this big up candle in here, and then this big down candle. It's pushing away from it. This is when the algorithm is changing its state of delivery from buying to selling. And then you can see we tap into it twice, and then you can see the reaction from there. It drops. Now, why does it have to tap it twice? Why didn't it just drop from here? Why did it come down and then come back up to it here? Well, if we look at the time here, it's 9 p.m. New York time. Now, the algorithm isn't doing anything at 9 p.m. It's, it's like it's middle of the night. So, well, it's not middle of the night, but you get what I'm saying. So that's why we expect small ranges, and then it taps back into it at 2 a.m. That is then the start of the London session. So we're in the London session. It's hit the impulse block again, and then bang, look at the reaction from there. Very good. And this was this morning as well. And then obviously it takes out sell side liquidity below this low, and then we just go into a choppy range. But this would be a good trade you could have taken. So you can see how these impulse blocks, when you're catching it. So again, you could have caught a retracement here, sell limit at this impulse block, and then you could have targeted this low, these lows in here, or the ultimate target could have been that low in there. And obviously in this example, all targets would have been met. And these are really good for like sniper entries. And what you can actually do is you can go on like a lower time frame in here, and then you can try and scale it down. Maybe go on like a 5 minute, 2 minute, 1 minute around that time. And you can find lower time frame impulse blocks, or you can find imbalances, or you can use the buy stop, sell stop scenario that we showed. So does that make sense to you guys? Do you guys understand that? Yeah, great insights. Awesome, awesome. So obviously we want you guys to go into the charts and start finding impulse blocks for yourself. So what you want to be doing is you kind of want to have a bias. So kind of look on the daily time frame. What is your bias for the daily time frame? Is it up or down? And then go on the lower time frame, like the 4 hour, the 1 hour. Because this is for intraday trading. I'm pretty sure a lot of you guys want to be intraday traders. And then look when it trades into an impulse block. Look at the time it trades into the impulse block, and then does it obviously give you a good reaction, or does it fail? And kind of study that. And we'd love to see some of your charts in the group as well. See what you're saying. But I think that's everything for this call, guys. I hope you've enjoyed, and obviously make sure you go into the charts and you study this yourself as well. Because obviously that's the most important thing. You can't just pick the skill up just from watching videos. You have to go into the charts and study it yourself. But at least now you know what you should be studying and what you shouldn't be studying. So I hope you guys have enjoyed this call. What day is it? It's Wednesday. So the next call will be on Friday. And yeah, we'll see you guys then.
Yeah, have a good week, guys. Yeah, that's the homework for this week. Get sending those charts in of the impulse blocks. Show us, so we want to see what you find.
Yeah.
But yeah, have a good week, guys. See you Friday.
See you guys.